Hey everyone, how's it going? It is 1 o'clock. We just got the market close. I'm just noticing that my ticker is not showing the right thing, but that's okay. Let's see how the markets went today. So one thing that we've been watching very carefully, or I've been watching very carefully, is the volatility index. We are closing at 20.49, so we now have elevated volatility. I warned of the risk of that Monday afternoon, and we started to get heightened volatility the last couple of days, and we are now above that 20 mark. If that continues into tomorrow, we could start seeing the market pull down even more. So far, the market has really just teased us. Every single day, it seems like that we're going one direction, then we go another direction. And for the most part, most of these days, we end up closing kind of close to where we opened up. So that was definitely true today. We had a bull trap and then later on a bear trap and then a last minute surge over here that brought us up to 560. Let's see where we close. 567.88 all day. Gamma was indicating that 567 was probably going to be the level, and that's pretty close. 567.77. At least we got the portion, the handle, the portion before the period, before the decimal point, correct. So let's take a look at this from a zoomed out overall perspective. We see that we came and we touched or we challenged the EMA 20 once again. We didn't break out above the EMA 8. The high was barely above it, but right now we're just kind of pinched in between the EMA 8 and the EMA 20. So it looks sort of like we're going to consolidate. That's what we've been seeing. We had high volatility over here and consolidation. If I want to be more lenient, I guess we could say that this was we could have gone up to here and then now we're moving down like this. So it looks a little bit more like a peak, like a high and a pull. But for the most part, I would just call this really choppy sideways movement ever since the FOMC announcement. So we had FOMC announcement on the 18th, the overnight pop, and then just flat ever since then. And that's what we've been talking about as the highest probability event. The highest probability event. It was a chop sideways. And for now, it's looking like it could last all the way until the election, unless there's some sort of big catalyst that bumps us out of this. So far, there hasn't been, even with all of the news that we're getting out of the Middle East and missile attacks and all of this, is just not really moving the markets. So we really need a market specific catalyst or a really, really big world geopolitical event in order to knock us out of this. There are a lot of risks in the market right now. We had the FOMC, we had the Federal Reserve cut by 50 basis points. The market went nowhere. The Chinese cut by 50 basis points, and theirs definitely went somewhere, but they've been on vacation. And we could, when they come back from vacation on Monday, we could see a lot of profit taking. So we could give all of this back. And it's still to be seen whether or not this is effective, whether or not the Chinese policies are effective in jumpstarting that Chinese economy. If it's not, and the U.S. market starts to cool down, and the Chinese market is still depressed, then we're talking about the possibility of a global recession, and that's just even more dangerous than simply the U.S. going into recession. We have the events in the Middle East causing us some uncertainty. If that uncertainty keeps on going on or the conflict escalates, then we're going to see spikes in oil. We're already seeing that spike up in oil. If we break above these, well, let's just draw this. I didn't even notice this today because I wasn't following oil. But look at that. We broke above this downtrend. So we do have a couple more resistance levels in terms of moving averages, but not super important ones. We are just barely above the EMA 100. This MA 150 isn't that important of a resistance level. So once we're out here, if we stay up above this trend line, that's now a change of trend and oil goes up. If oil goes up, then everything gets more expensive. If everything gets more expensive, then excuse me, just a moment. I apologize. I'm okay. Sorry about that. So we had a small issue with with a one of the employees' families. So we'll wish her the best, and I'll continue on with the analysis. So oil spiking up, that makes everything more expensive. So, if oil is more expensive, then transportation is more expensive. Shipping goods from one place to another becomes more expensive. Operating a factory, operating manufacturing becomes more expensive. So that is unfortunately inflationary. If if uh, if we have the port strikes, if those keep on continuing for an extended period of time, then we have a limited number of goods that can travel back and forth. We have an increase in expenses in terms of having to divert goods to different ports. Then everything becomes more expensive. That becomes inflationary. And then that is egg on the Fed's face because they cut by 50 basis points. They were so confident that everything was going as planned that they cut by 50 basis points. And oops, if any of these things have legs, then they're going to have to start raising again. So there are a lot of things that are going on. There's even more going on. So we have that both of those events could have a impact on the dollar. Dollar has been moving up the last few days, and we've been breaking out of this horizontal range over here, or it looks like we might break out of this horizontal range. Like we just kind of poked above it. If this continues tomorrow, then I'll call it a real breakout out of the horizontal range, and that starts to put pressure on things like gold. And a lot of people have been using gold lately, thinking that it's going to keep on going up. And depending on what happens in the world, yes, it could keep on going up. But what is more immediate than anything that is geopolitical, that like, oh, the Chinese keep on buying a whole bunch more gold. We think that there's going to be a recession in the future. That while if the dollar goes up, it's immediate. It is immediate impact. It's within minutes. There's an impact on the price of gold, not a few months down the road. So if this U.S. dollar keeps on going up, it's going to make it very difficult for gold to continue going up. And as you can see, 1, 2, 3, 4, the last 4 days, what happened? We had a pullback and then a chop sideways in the gold market while that US dollar was increasing. So as long as that US dollar keeps on increasing, it's going to be difficult in the short term for gold to keep on moving upwards. What has to happen is that demand for gold has to outstrip the pace at which the US dollar is growing in order for gold to continue to move up. That's possible if people are really afraid of recession, or if the Chinese just have this huge appetite for gold still, then that will happen. But for now, the more immediate pressure is from the US dollar, and that is preventing gold from moving up from here. So I'm a little cautious. I know there's a lot of gold bugs. I talked to a lot of people who are very optimistic about gold, and I'm just like, ooh, well, it's we've moved up quite a bit in the past few months, and this is a appropriate pause, and it might be even pullback if this dollar keeps on moving upwards. So there are a lot of risks. There's more that I had in mind earlier, but I can't entirely think of right now. Let's take a look at our VIX is elevated. Our CPC it's not a great. Let's look at it this way. Our CPC is at 0.79. That's kind of low. You know, 0.8, we adjusted to 0.7 to more normalize it, but in the past we always used 0.8. So, and we did hit 0.7 right here. So, and that is where we started to pull back. And until I get a more normal read from the CPC, then there's a little bit of sign that we could pull back a little bit more. So far, none of that has manifested though. We are in a larger volatility environment, meaning that we have to accept a larger range of movement before we think that something is significant. So is this significant? Well, this to this, that was a significant move. But if it's just this to this right now in the high volatility environment, that's not really going to be a significant move. So unless we get them piled on top of each other for multiple days, then it can turn into a significant move. For now, these large ranges are making it uh, harder to say that it's moving in one way or the other. That's just a big chop sideways, basically. So overall, that's what I'm going to expect. Yes, we do have risk to the downside, but it doesn't mean that we are going down. It just means that there's a good chance that there is a higher chance of us moving down than us moving up. And if we do move down, there is more room to go down than there is to move up. So we just have to stay neutral and maybe lean slightly bearish or be prepared for a bearish move. But at the same time, when I was looking at the gamma exposure earlier, we see that there is a lot of pressure and a lot of things building up to the upside as well. So about 580, that's what I was telling you guys before. Maybe 580 at the most. I'll chop sideways until we get to those elections, and or at the very least to the next options expiration. So for 2 weeks. And then if we break out of 580, or if we break below 560 or 555, that's what I'm going to consider a choppy range for now. If we move above 580 or we move below 560, 555, then this room, because of all of the gamma exposure that's in the market, this market does have the potential to really start running upwards or really start moving downwards. We're not particularly close to either one of those. So for now, we're just looking at this market as if it's going to chop sideways. So after all of that, what sectors can we look at? What can we expect? Let's take a deeper look, because if there is a rotation going on, we do want to know about it. So are we going into safer haven stocks? Are we going into riskier stocks? As we're chopping sideways, if a particular sector is emphasized or a particular group of sectors is emphasized, then that will give us a clue as to the direction that it might break out. So I'm going to go over to the sector scan and just take a look at how everything is doing. First, actually, let me see how much money went into each sector. So by far the biggest attention was given to energy. So that tells me that there is attention on the events in the Middle East. We've got silver. Silver is basically playing catch up to gold. Gold was flat. So silver's just playing catch up there. Then we have some attention in SMH. XLK, I would just call that random. So specifically chips. That's kind of interesting to note. So chips are up 0.69%. Let's see anything that is down at least 0.69%. So that would be bonds continuing and move down. That is really interesting because ever since September 18th, this bond market has just been going down. That means rates are going up, which is not what you would expect when the Fed cuts by 50 basis points. So this is completely flying in the face of what the Fed's actions were. And it does the actual effect right now is that we are in an interest rate increasing environment. So we'll have to see how that plays out. The interest rates increasing, that is just saying that this curve is steepening. Short-term rates are set by the Fed, and long-term rates float by the market. So now long-term rates are going up, short-term rates are coming down. That is a reversion of the yield curve, and that can potentially signal a recession, but not immediately. In order for us to go into recession, every single recession, with the exception of COVID, has been triggered by a a increase in oil, and we're getting that right now. It doesn't matter that it was caused by this uncertainty in the Middle East. If this drags on and the oil just keeps on moving up, suddenly our risks of recession increase. And it's for all the reasons that I listed earlier. Everything becomes more expensive business wise. Transportation, manufacturing, operations, all of it becomes more expensive. Just think about Bitcoin and all of the cryptocurrencies. How much energy does all of that eat up? And how much of it is really realistically is powered by solar? How much of it is powered by natural gas? It's still predominantly oil. So even things like crypto could take a hit because of increasing energy prices. And then everything becoming more expensive, that slows down the economy, that slows down our output because of everything is more expensive. The cost of everything to produce everything goes higher, and that could in turn reignite inflation. So if this oil keeps on going up and we're in that interest rate reversion environment, suddenly the risk of a recession starts to increase rapidly. So that's definitely something that we want to keep an eye on. The other thing is a strong dollar. While it's good domestically for the US, it creates buying power for us in the US. At the same time, we've got to think that we're in a global economy now. If we look at the S&P 500, how many of these companies do business overseas? And at what percentage point of their revenue is from overseas? So if I look over here and I say, well, does NVIDIA do overseas sales? Yes, absolutely. Microsoft, Apple, absolutely. Meta, yes. Maybe not in China, but yes. Google, yes. All of these really, Amazon, less so, but yes. Again, maybe not in China. Walmart does for sure. Coca-Cola does for sure. So all of these really big names, Eli Lilly, are they international? And what percentage? So for example, Apple's revenue from overseas is roughly 70%. So when we have a weak dollar, it allows them to repatriate dollars a lot more easily, and they seem a lot richer. When we have a high dollar, then when they repatriate back into the US, for example, when they report earnings, their earnings don't look as impressive once they convert it back into the US dollar. So a strong dollar, while it sounds great, actually, when it comes to the stock market, it's not necessarily the greatest news in the world, because Apple could have made $1 billion in Russia, let's say. But if the US dollar is so strong that it turns into $1 million per, I guess they use ruble. I'm not sure what they use. I think ruble. Then it looks like they only made, what is that, $100. It is not, it does not look good for earnings. So it makes it harder for these international corporations that have a large amount of revenue from non-US to actually report earnings and earnings beats if we have a strong dollar. So all of these things coming together right now are just saying that the possibility of a recession is increasing, and we need to be aware of that. And so I keep on saying that there's more risk to the downside than there is to the upside. And that is becoming increasingly true. It was true for ever since I started saying it, I think maybe 1 or 2 months ago, but it's just becoming more true. The risk, the difference in that risk is just becoming bigger and bigger. And we want to be very careful of that. Now, it doesn't mean it's going to happen tomorrow. It doesn't mean it's going to happen anytime soon. And it doesn't mean that we want to go bear. It just means we want to be careful and watch out and just keep our eyes open for that possibility. Right now, in the S&P 500, we are still above nearly every single moving average. We still have a perfect rainbow. We're still above the MA 200. When we looked at momentum yesterday, it was still beautiful momentum. We still had a significant percentage above the 50-day moving average and above the 200-day moving average. So we're not there yet. We just want to be careful in case that it starts to go there. So for now, I would just be very neutral in my portfolios and be very careful about which sectors that I'm going long in particular. Short, if things go to the downside, then every sector is going to start tumbling. So the shorts I don't have to be as careful about, but for the longs, I definitely want to be very, very careful. So let's take a look at quickly what sectors might be okay to go long in. Yesterday, we came up with XLU, XLI, ITA, and XLC. So let's see if it still looks that way. So silver still bumping up bumps of resistance right here, looking like it's chopping over the last week or so. So that's very similar to what we said about gold. SMH, we're just not there. The chips, even though they were one of the best performing sectors today, it's just not there. We pulled back from this high and we haven't fully bounced upwards yet. It looks like maybe we bounced off of that EMA 20 or the MA kind of close to that MA 50, but unconfirmed yet. So I would be very careful about going into SMH, XLK, same with XLK. Gold, like I said, from a pulled back perspective, it looks good, but the last week or so has been chopping sideways, and we have that danger coming in from the rising US dollar. So I'd be very careful about GLD as well. XLU still looks excellent. QQQ, same thing as SMH and XOK, SPY, chopping sideways. So I'd be careful about that as well. XLC still looking surprisingly good. We did have looks like a mean reversion to the EMA 8. If this can move upwards, if this can bounce off of that EMA 8, then XLC looks great. Then we've got home builders mostly chopping sideways. Dow Jones chopping sideways. XLI not as good as it looked yesterday. So now with that mean reversion today, it look a lot more flat than it did yesterday. So I'd be a little bit cautious about XLI. Financials, same thing. ITA, a little bit of a mean reversion right here, but not even all the way to the EMA 8. ITA is still looking very good. So far XLU and XLI, and if XLC can bounce, then XLC. Everything else is just not looking that great. We've got healthcare breaking down, which is one of the most defensive sectors. We've got XLP doing a very similar thing, looking like it might have been, we'll see how it reacts to that MA 50, but it's not looking super great for XLP. So we're not in a high flying environment. We're not in a super bull environment. We're not in a place where SMH and XLK and QQQ are leading the charge, where IWM is leading the charge. So this weakness in the XLP is not a good sign because it's not associated with strength in the riskier sectors. So this has me a little bit worried that we saw, and then we saw that with XLV as well. Two of the most defensive sectors are having trouble and they're struggling over here. So that is not giving me a lot of optimism. XLY continue to break down as well. Yeah, things just are not looking that rosy. I'll just put it that way. I'm not a bear. I already told you, we already went out that we're not bearish yet. We are just saying that the risks to the downside are piling up right now. For now, we're chopping sideways. Everything from a pure technical standpoint still looks like it's bullish, but the fundamental picture is saying that the fuel for this movement upward just isn't there. And if it starts to sputter and we start to move down below that MA50 and then the MA200, then we'll be in a bear market. We just are saying that there's weakness in this market. It doesn't look like there's a whole lot of strength to keep this moving upwards. And we've had a lot of really strong catalysts over the last month and a half or so, 2 months, and the market just never got the wind to keep on going upwards. So it doesn't seem like there's going to be a strong catalyst that really moves this upwards without a correction first. So we had a correction and then a pullback so far this year. Or was it this one? What I think there's this one. So correction and a pullback. So at the very least, another pullback is in order before we can go above this 580. That's what it's looking like to me. So just be careful. We're looking for at least a pullback sometime soon. I know there's a lot of people who are super bullish about Q4, and we're going to have this amazing end of the year, maybe, but I'm looking for a pullback before that, or I'm looking for a pullback and then maybe weakness in the market. So I'm not ruling out the downside just yet. But most likely it's just going to be a large chop fest into the election, and then we'll see what happens from there. And so that is it. We have a lot more macro picture today. Stay neutral. Be aware that we could move up, we could move down. Most likely we're just going to chop sideways. And if we do move down, it's probably going to have a lot more room and be a lot more violent than if we move upwards. So that's it for today. Have a wonderful rest of your day, and I will see you all tomorrow.